Can you guys see my screen?
Yes, we can see it.
Perfect.
Okay, great. Hello everyone. Thank you guys so much for joining Learn to Earn's third session tonight, which will be on venture capital and led by Michelle and Sonia, who did an amazing job last week. And if you guys are comfortable, you can turn on your camera, but if not, that's totally fine. And it's going to be the same format as last week, so a presentation followed by Q&A. And if you have any questions during the presentation, feel free to use the raise hand function or the chat function, so that way you can ask questions. And besides that, I think we're ready to get started. If Sonia and Michelle, you guys want to begin.
Yeah, just a quick question. Patricia, is this the same group from last week or should we do introductions?
I think you guys can do introduction. It's like relatively the same group, but maybe a few different people from last week that weren't able to come.
Perfect. Michelle, you want to go first?
Yeah, sounds good. So I'm Michelle. I'm an associate at Longitude, which is a venture capital fund. Before joining Longitude, I worked in healthcare investment banking at Lazard, which is sort of a boutique, smaller bank. And then before that, I was at Wellesley College, which is right outside of Boston, where I studied biochemistry and economics.
Perfect. And I'm also an associate at Longitude. I've been with the firm for about a year and a half. Prior to that, I worked at Credit Suisse in investment banking, covering healthcare. Before that, I went to Columbia undergrad, majored in econ, did a business concentration, all that jazz in New York. So happy to answer any questions. Would encourage people to ask questions along the way in case you have any, but otherwise we'll keep running with it.
Great. Okay, so the first thing we thought we'd cover was an overview of venture capital, or VC for short. So what is venture capital? Well, venture capital is a form of private equity. And what do we mean by that? Well, private equity just means that we invest in companies that are typically privately held / not traded on a stock exchange. Last week, we went over stock exchanges like the NASDAQ. So all the companies you see listed on a stock exchange or the NASDAQ is a public company, and you and I or other funds can buy stocks there. And by that, we're buying a percentage of ownership of the company versus you and I can't invest in a privately held company. That's where VCs come into play. So there are a range of funds that invest in private companies, like other venture capitals or private equity funds. And they're generally classified based on the stage of the company that they invest in. So, for example, venture capital invests in very early stage companies versus private equity, which is private equity is an umbrella and venture capital falls underneath it. But generally, when people say private equity, they're referring to the type of fund that invests in much later stage companies. So what does this early stage versus late stage mean? Well, an early stage company can be a company that doesn't even have a product yet. Maybe they just have an idea, and we're just so convinced by, the team or, their conviction around an idea that we decide to invest in this early stage company. Versus a late stage company would already have a product, and that product might already even be commercialized. And what that means is just that this product is being sold to consumers. So that's sort of the distinction there. VCs will invest money into these early stage companies and along the way help them build and grow their business. So the capital that they put into these early stage companies buys ownership of the company. And because of that, sometimes these venture capital funds will get a position on the board. So the board of directors is a group of elected individuals that supervise and advise the management team of the company. So the management team of the company can include the CEO, the CFO, the chief business officer, all of those high-level executive positions would fall under the management team. And the board's responsibility is to help them navigate major business decisions or just make sure that they're doing their duty as, the commanders of this company. Does anybody have any questions on this? We'll also do a Q&A session at the end, so no worries.
I was wondering if you could give an example of a private equity.
Yeah, so you mean like a private equity fund?
Yes, exactly.
So KKR is a big private equity fund. They're probably, I would say, the most well-known private equity fund. I don't know if Sonia disagrees with that, but they're you know, a range of private equity funds. TPG is another private equity fund. HIG is another private equity fund. A lot of acronyms.
Great, thank you.
No problem.
I just Googled it for my own interest. Blackstone is the biggest private equity fund, then Carlyle, then KKR. So Michelle, you're in top 3. You got it. Perfect. So where does a venture capital firm like ours get its money? Unfortunately, we also have to, as much as you're investors and you think you're on the buy side, you also have to sell to people who give you the money so you can do your job. And that's where what we call them limited partners, but those are the people who give venture capital money. And they're not actually people generally, they're large institutions. Think of like pension funds, insurance companies, and they have all of this capital and they need to put it somewhere and they want to get a return. So if you think about why these institutions would invest in venture capital, they usually have some sort of asset management strategy, but venture capital tends to be one of them, and it's a good diversification opportunity. So all of these investors in Longitude or in whatever are called limited partners, and they'll look for a rate of return that they would receive as general partners, so as limited partners. And so that could be the word IRR. I'm sure maybe you guys have heard, but it's called internal rate of return. And that's really the benchmark that they'll use to assess how well their investment in an investment firm is doing. It gets a little complicated, but I think the big thing to take away is we get our money from pension funds and insurance companies, and then we give them a return. So our goal is to make money for them, and they get money back from us.
All right, so what does a venture capital job look like? What does our process look like as we in them and then help them grow and then one day hope to make a return for limited partners? Well, where do we even find the companies that we end up investing in? That's what we call sourcing, and that's sort of a segment in this greater process chain. But sometimes these will be, cold email inbounds from just entrepreneurs that are looking to raise money to invest to grow their idea. Others can be relationships from other funds that we know, like tons of other venture capital funds investing in the same space. Sometimes, there are relationships at higher levels, and they're like, hey, we saw this really interesting company. Maybe it didn't align with our investment strategy, but maybe it would align with yours. So that's a way that we end up seeing a lot of different companies that are looking to raise money. And if we see one that is interesting, we'll take a pitch meeting, which is just an initial meeting with these companies. We get like an hour-long introduction to their management team and just a high-level overview of their company, their product, and their business plan. If we like what we see, we move on to the next step, which is due diligence. And this is where the bulk of our deal process work comes from. And it's basically us really digging into the company, the management team, and understanding everything there is to know about this company and whether or not we like it. So at Longitude, we have this acronym that's called TAVE, and it, at a very high level, just lets us summarizes what we focus on when we consider investing in a company. So the T in TAVE stands for team. At the end of the day, these are all really early stage companies. Tons of things can go wrong. This is high risk. So a lot of, what you're investing in is investing in the people. Like, do they have a good track record? Have they done this successfully before? All of that really matters. The next part is A, which is assets. So for us, we work at Longitude. It's a life sciences venture capital fund. So we will look across healthcare, and we'll really dig into the product. We'll talk to consultants. We'll look at any data that the product has generated. So I sit on the biotech team. We look at a lot of drugs, and it's not easy to get a drug approved in the US. You have to go through many clinical trials. So we dig into the data there. We consult experts, we hire consultants, and they'll help us do our work as well. The next is V, which stands for valuation. And that really just impacts how we're thinking about how much money we would invest in the company, what percent of ownership would we get. So it ends up being really important, because even if we like a company a lot, if it's incredibly high valuation, even if we were to put in a lot of money, maybe we would only own 1%, and that's not worth it to us. So that's definitely something we consider as well. And then the E is exit, which I will press pause on and talk about at the end. All right, so if we like the company, all of our due diligence has checked out, we'll move on to investment. And what that means is that we'll submit a term sheet for the company. So we'll say, hey, really like your company. We value you at, $100 million. We're willing to put in $10 million, so we would own, 10% of your company. And generally this process is a lot of negotiation. The company's like, no, we think we're worth $200 million. But eventually you'll settle on all the fine details, and you'll sign the term sheet, you'll wire the money, and you'll officially be owners of the company. So Longitude, for example, we like to take a lot of board positions, and we talked about that earlier, so that as we're helping the company grow and develop, it's not just like we're giving them advice and they can take it or maybe not take it. We're on the board. We ultimately have a vote and say in any major decision that they do. And oftentimes we'll be sitting on these boards and helping these companies and be invested in these companies for years. So we really do a lot to help them navigate, how are they gonna get their product to market? How are they gonna launch their product? All of that stuff, we're walking alongside the company every step. And then eventually, hopefully, we'll get a good return for our limited partners for all of the work that we put in, figuring out what is a good company, helping that company grow over time, and how do we actually get our money back. So generally, we either get a return through IPOs or M&As. So we said earlier that the companies we invest in are generally private. So they can go through a process of an IPO, an initial public offering, to get listed on the stock exchange. So that now you and I and everyone can buy or sell ownership of this company. Over time, we can decrease our shares or percentage ownership at hopefully a higher price than we initially invested in, and we can get a return that way. We can also hope that a bigger, more mature company buys out our company at a premium to where we initially invested, and that's another way we can make a return. And generally, we try to return a 3x on our investments. It's just a helpful benchmark as you think about, different types of investing, what you're actually looking for. So what that means is, say we invest 10 million, we hope to at least make, 30 million back in 5 to 7 years or something along those lines. Does anybody have any questions on this page?
Perfect. Michelle, that was super helpful. And I think walking through the mechanics of how the VC fund works and kind of how we get to the diligence stage is super important. And I think one thing on this page that would be probably interesting is if we tell you guys what a day looks like for us. I would assume that it changes. I mean, I know it does. It changes as you get older, and generally at the MD level, so highest possible position, those are the people who are holding the board seats and more involved in those discussions. So just to give you guys an example, as an associate, basically, let's say I start my day at 8:30. we're feeling really good about ourselves, starting the day right on time. Usually it's around 9:15, but 8:30, wake up. First thing I do is read the news. So I'm really checking to see, like, are there any financings that happened of companies that we've been tracking? Have any deals happened? So to Michelle's point, have any companies been acquired? Have any companies gone public? Usually for going public, I have a decent sense of before, because you have to file confidentially. Then you have like a period where you're not confidential, and then everybody knows, and then you go public. So those are generally less of a surprise, but M&A, merger and acquisition, tends to be a bit more of a surprise. So I'd say it's been good 30, 45 minutes checking on that. And then I do spend a little bit of time just seeing if there's any new interesting articles. So I sit on our software and services team. So I spend a lot of time looking at like any new AI types of technologies that are being used, anything new in virtual care, just like things to be aware of. And there's certain websites that I go to. And Michelle does the same thing, a lot of like drug regulation. Is there anything we should be monitoring from all of the FDA, CMS? There's lots of different entities that kind of control our healthcare policy. So I'd say we spend maybe like 30 minutes to an hour on that in the morning. And then it's time to probably get into some deal related work. So I would say for me, 80 to 90% of the time, I have a deal that I'm working on, which is the process Michelle is describing. So there's something that I'm interested in. And when I say I sit on a team of 4, so we are interested in. And so we get something called the data room, which is access to all of these company files. It'll be like an industry overview, a company overview, a financial model, a pipeline, like everything you can possibly think of that you would need to know in order to potentially make an investment. So a lot of things Michelle talked about. And I'm usually spending like at least 4 to 5 hours in that data room, reading through these files, taking notes, poking holes in it. I really thought the most interesting parallel someone told me was like, as an investor, you're a forensic scientist. Like you're reading through these papers and you're trying to figure out like, why would this not work? What will break this model on a financial perspective? If this thing goes wrong, what will fundamentally alter our entire hypothesis? So you really are looking for holes and questions and things to probe the management team on, because at the end of the day, you're taking on a huge risk by investing in this company. And so you really have to make sure you can get comfortable with all of the downside scenarios. And then of course we look for upside scenarios too, which your company takes off, numerous indications, or however you want to think about it. So then I probably, after spending a lot of time on deal work, I probably do a little bit of sourcing work, which is a little bit of what Michelle was talking about. So even if we are working on a deal, if we're in term sheet stages, which is what Michelle was talking about, where like we're submitting a indication of interest, which can be a binding agreement, then I'm spending 100% of my time on that. But if it's not at that stage yet and we're still doing the due diligence, then I'm likely doing a little bit of sourcing as well, which is a lot of just keeping track of companies that are interesting. Are they attending conferences? In 2 weeks, I'm attending a conference. So right now I'm doing a lot of sourcing to figure out which companies I want to meet at the conference and which companies are high priority for us. And then honestly, probably back to deal work. And sometimes as an associate, there's just some logistics like logging the companies and administrative work and things like that. So I think that's probably like a day in the life. I don't know, Michelle, if yours is any different.
I would say that the day looks really similar. The only other thing I would add is just that we also spend a lot of time managing our portfolio companies. So these are companies that we're already invested in, and we can help them with honestly like any major decision that they're making. But for example, like if one of our companies is looking to raise their next round, say we were already invested in their last round, we'll try to put them in touch with other venture capital funds, other interested parties, help them with that. Like it could really be a range of anything, like thinking about how are they viewing their business development plan? Are they bringing in another asset? We'll help them evaluate these new assets and all sorts of good stuff.
Yeah, and I think that's a great point, Michelle. Portfolio companies are a big part of what we do. And we are the type of fund where once we make an investment, we do participate in future rounds. So it's pretty integral to our thesis that we continue to help a company grow. And so when we make an investment, we actually allocate money for future investments, so that we're always staying true to the investment that we made and the commitment that we've made to the company. We spent a lot of time on this page, but it's the most important page. So, all right, this is a little bit of what Longitude does. So I'll touch on it really quickly for those of you who are interested in healthcare, and for those of you who are not, I think this is just interesting to know what's happening in the space. I would say that for most VC funds, they do tend to be sector specific. So you'll see like a lot of funds will do specifically consumer or specifically fintech. Some will do maybe one or two. But for the most part, I think, especially in the biotech space, you're going to see that people are very focused on biotech specifically, mostly because it requires a level of medical knowledge. So a lot of the biotech investors Michelle works with and we work with as a firm are PhDs, they're MDs. One of the person I work for was a doctor for 15 years and is now a venture capitalist. So you'll see that a lot in the healthcare space, and it makes for really interesting and fun due diligence processes because it's a doctor talking to a doctor or someone talking to a lab technician, and you get really in the weeds on the science. So I would say you generally have to have a passion for that to enjoy this type of work. But biotech is essentially things like cancer, eye disease, kidney disease. I think you guys have a general sense for that. Medtech is what you can think of like implantable instruments. So, a pacemaker, or if you get like a hip transplant, a lot of those different types of surgeries tend to require medical instruments and things like that. So even diabetes care platforms can be constituted as medtech. So a lot of the work we do in medtech tends to be cardiac focused, and that's just because that indication specifically requires more instrumentation and like more management of the actual muscle. And health solutions. Okay, this is the best one because it's mine, but it is software and services. So probably what you guys have been hearing most about since the pandemic started, it's their teledocs of the world, I just want to get on video chat and talk to my doctor and get medicine in 15 minutes. That's the space that I sit in. And it's been really crazy for the last 24 months, I would say. This is like unprecedented activity, which makes it really cool to see, but it's a lot of chronic care management. So as our society continues to get lifestyle diseases, which are, think of diabetes and a lot of like obesity related diseases, I would say, these types of chronic care management platforms become really important. So there's also we do a lot of mental health, so a lot of behavioral health platforms. So maybe you guys have heard of Talkspace. I think Michael Phelps is on the ad. And then a couple of other like online therapy type companies, addiction treatment type companies. So we do a lot of that stuff too. And it's a really interesting space because the services side of it, so it's software and services. So the services side of it, you could think of like huge hospitals, but obviously, as Michelle mentioned, we're not going to invest in a hospital. That's a very late stage company, but we would invest in a company that's trying to basically prevent you from going to the hospital. So they want to help you manage your care, and so you never get to the hospital. And so they're considered like a disruptor in the space. And that's a big VC buzzword. Everybody wants to be disrupting, traditional healthcare, mostly because it's extremely inefficient. So these are examples of some of our portfolio companies. And I think the next page actually has two cool examples. So Eargo is a medtech company that we invested in. It is a hearing aid company. It's super cool because you actually can't see it in someone's ear because it's so tiny. That's actually a big thing we're seeing in medtech specifically, is like taking really big, hefty, bulky devices and making them tiny. So it's a lot of like microscopic technology that's been really interesting. So Eargo is a fun company that we invested in, I want to say late last year. And then Immune is actually a company that we've been invested in for a very, very long time, and one that's very near and dear because of peanut allergy. I mean, it's just a really tough thing to be a kid and have to deal with peanut allergy. So this is a pill which contains a powder, and you take the powder and you pour it on your, child's food. And over time, they learn to develop a tolerance to essentially the small microdoses of peanuts. And it's been life-changing for lots of kids, ability to go to school and things like that. So those are two of our most fun investments, although all of them are fun. And now we're at the Q&A. So our paths to venture capital. We can spend some time here, but we'd love to answer your questions first, if you guys have any. Okay, well, we have a couple minutes, so why don't we touch on a little bit of, Michelle, you talked a little bit about private equity, but if you thought about like late stage versus early stage, how'd you kind of navigate that decision?
Okay, that's a good question. I mean, for biotech, I mean, honestly, everything is sort of a spectrum. So I wouldn't say that there was a hard cutoff for early, mid, or late. For me and the investments that we've seen, some of them are like so early stage that it's really just a team and, you know, oh, we think if we went after this target, it would work, but we don't even have like a drug. That we've invested in things as early as that versus how I would classify late stage for biotech at least would be like we almost have a drug, like we have something that we think is about to be approved. I would consider that to be late stage, but generally how I would classify it is if a company is generating revenue, like if they're making money, they're not early stage, they're probably late stage, and they would be the focus of a private equity fund. So private equity funds will look at companies that are generating revenue, but maybe they're not the most efficient. Like maybe they have really high costs, like high operational costs. Maybe they have really high like sales and marketing costs. And the company is doing really badly, even though they do have a product and they are generating revenue. So a private equity fund will come in, fire everyone, and then improve their margins so that the company is now like way more profitable, and then sell it and then make a ton of money that way. But you see how that's like very later stage than like what we do, which is like, we don't have an idea. We're in this for the long haul. We're going to build a company together around an idea or something like that.
Well, that's it. You answered actually a much more difficult question than I was intending to ask. I was more going for why'd you pick venture capital over private equity, but you answered in a much more interesting way. I think that for someone in Michelle and I's position, both of us did about 2 years of investment banking. And after that, people tend to go really in one direction, which is private equity. It's kind of like the natural path. And there's this big recruiting cycle, and it's all this fun you guys have to look forward to if you decide to pursue this career path. But private equity, especially in healthcare, which I think Michelle and I were both really focused on healthcare opportunities. So our experiences, we should just caveat that. But with healthcare specifically, it tends to be like really older, like much older, later stage companies. So it's a lot of hospitals, like things like that, which were less interesting, I think, to both of us. And specifically for Michelle, who has a science background and really wanted to pursue biotech, that's just really not a private equity asset class. And biotech's really all about early stage, building the company, taking an idea, commercializing it. That kind of expertise doesn't necessarily flow with the mindset of private equity, which is what Michelle was just talking about, all about like optimizing your margins and your cost. And we're all about growing a company. And, our big thesis is we can take an idea and we can take a molecule and all of that, and we can turn it into something that you would want to acquire, or you want to buy shares of on a stock exchange. And we think we have the right expertise to help you guys, being founders, navigate that process. So I think it's a really personal decision. Some people love the deal environment. They really like the transaction kind of dynamic. And I think you get more of that on the private equity side because you're working on billion-dollar deals. Like Michelle and I don't work on billion-dollar deals. Most of our check sizes are probably somewhere between 10 million and maybe 30 to 40 million. And that's high for us. On the private equity side, you're talking about 500 million all the way to $1 billion, even larger than that. So it also tends to require a little more from the associate perspective. Like I talked to you guys about a little bit of what my day looks like. So I do spend a lot of time understanding like clinical due diligence, and I read papers and I look at industry overviews, and I spend a lot of time on maybe what you'd call non-financial things. And I also spend time on the financial model, but it's just one piece of a puzzle. On the private equity side, as an associate, it is your job. Like that is 80 to 90% of your workday. You're spent in Excel, you're modeling, you're doing scenarios, you're running a bunch of different, debt equity combinations, whatever it might be. But your job is really focused on the financial sensitivity part of it, which is super interesting, but it's definitely a personal decision about what you enjoy more. If you're really into the financial mechanics and different ways to structure a deal, I think private equity could be great. If you're a little bit more interested in growing a company and the industry itself and trends and, a lot of like clinically grounded diligence, I think venture capital could be really interesting. So it's just a spectrum, and there's obviously stuff in between. I'm giving you guys a very black and white version of it, but just to help characterize what are some of the opportunities post banking. I think you guys have already heard a little bit about banking, but usually tends to be like a 2 to 3 year gig, and then people are on to the next thing. And maybe with that, we do one more question. If there's nothing from you guys, then we'll do, I think this one might be the most helpful, but did any college or high school courses prepare you for this career path? Want to go first, Michelle?
Yes. I would say, I don't know if I took any courses that would be helpful. I wish I had taken accounting ahead of going into banking and VC. Well, you kind of learn accounting by on-the-job training in banking, but getting we call it financial literacy, to be able to look at an income statement, look at a balance sheet. Those are the there are three major financial statements that can basically tell you, how the company is doing. Being able to understand those three statements and how they flow together. It's definitely a lot of memorization. It's a lot of work. There's a reason why it's a full college course. But I think I had wished I had done that in college versus learning it on the job. But in general, I was really interested in health and like biology, chemistry in undergrad. And that's a big reason why I wanted to stick to healthcare and biotech VC now. But in terms, if you were just going to finance broadly, I would say that like accounting is probably the most important, and most of the other training you'll get, like Excel and PowerPoint, you'll learn, I think, on the job. Like you don't necessarily need to like prepare for it. Like it is nice to know the shortcuts ahead of time, but people pick it up. What about you? Yeah.
No, I think I'd agree with that. I don't know that I could pinpoint a course in specifically. I think I'd say for me, I wasn't pre-med and I didn't really have a medical background, but I did take one or two like biopharma regulation classes and things like that. And I think those sparked a natural interest in me. One thing I would say is just college in general teaches you / nurtures this intellectual curiosity, this like discomfort with not having all the answers. And I think that actually has served me really well in venture capital, less than investment banking, but a lot in venture capital. That whole, I have 15 questions. I don't really understand this. What happens if this happens? Like that whole, forensic scientist type mindset. I think college was really instrumental for me in kind of cultivating that. And so whatever classes you might take, I went to Columbia, so I took like a billion literature classes. And if you take science classes or whatever you may choose, wherever you may choose to go, I think that keeping that in the back of your mind and having that discomfort with not having all the answers can serve you really well in the investing world. And there's lots of other types of investing. We didn't cover everything under the sun. There's hedge funds, there's long only asset management, and there's a billion other things, but these are just some of the ones that we've encountered. And here's some more resources, just as you guys continue to navigate what you might want to do. And then my email and Michelle's email, we are happy to answer questions. We actually have an office in Greenwich, which is not, it's not far from GA. So, you know, to the extent we can be helpful with anything, we're really happy to do it. And you guys are great for showing up to this at 8 p.m. on a Wednesday. So good for you guys.
Awesome. I think that was amazing. That was an incredible introduction to venture capital. And I think those questions really pinpoint what everyone kind of wants to know. And I know that for myself, those are all very like intriguing concepts that you work with. So thank you again. And I would just like to say for the other people who will be joining the next few sessions, that I will be sending a feedback form if you guys have any comments or suggestions. And like Sonia and Michelle said, you guys can feel free to reach out if you guys have any further questions. But that was amazing. Thank you guys so much again.
Thank you guys. Have a good night.
Good night.
Bye. Have a great night.